Yeah, hi traders. Smooth Forex here. Today's class we're gonna be talking about different Forex strategy that I use in making profits in the market, and then I'm gonna be teaching us different entry types. You understand different entry types. Before then, what I actually always want us to know is this. Um, for any strategy you want to use, whatsoever strategy you want to use, be it SMC, price action, there's one thing I always bring up in the picture. I always tell my students, which is having a trading plan. If you don't have a trading plan, if you don't have a good trading plan, and how to apply risk management to all your trading, whatsoever strategy you're using is gonna fail. You understand? Whatsoever strategy you're using gonna is gonna fail. No matter how good your strategy is, even with how good your strategy is, you're still gonna lose money if you don't have a good trading plan and don't know how to apply risk management. And then when you don't have a good trading plan and how to apply risk management to your trades, this is where psychology comes in, and then psychology starts making you take some kind of trades that would make you blow up your account. You understand now? But then before that, let's get to the real business. But then I want to believe we all know. I want to believe you know what market structure is, because whatsoever strategy you're going to be using all deals with market structure. So now, for those who don't have an idea of how market structure works, this is how it is. And I always use this particular scenario. Wherever there are buyers, you wait for sellers to come in. If you're in an uptrend, wherever there are buyers, just like this, if there are buyers, you're having market creating higher highs, you wait for sellers to come in, and then you look for what market to pull back into an area where you can actually buy the market from, and then right from there you should enter the market when you spotted an opportunity. And then after market has been after market has buyers have come into the market, you wait again for sellers to come into the market. It is just simple. Once you're in a uptrend, all you always look out for is buying opportunity, which is buying the market at a low price. That is where the only thing you want to look out for. Always buying the market at at a very at a low price. That is where you should be buying the market from, at a low price. You can't be buying the market when it is expensive. You always want to buy the market when it is it's in a cheap area for you to in a cheap area. That is where you're looking to buy the market all the way up. That is the simple scenario of how all this works. And now there's something I want you guys to feel. The market doesn't just create structures, clean structures. You can see market creating structures just like something like this. You can see market creating something like this. You can see it creating something like this. Create something like this. Then you see market creating something like this. Something like this. Now, if we are to explain this now, let me take this down right from here. Now, if you are to see something like this, now market doing something like this, now you'll be like, okay, how can I mark? Sorry, you'll be like, how can I mark structure? How can I look out where is the last high the market created and then where is the last low the market created? That's what's going to be up in your head. Like, okay, how can I identify the recent high and the recent low? This is simple. You let's start from what I call the base. If it's a bullish trend, you start for what I call the base. Now look at this particular drawing right here. It is all looking so rough, and now you look at, okay, from the base, let's look at the lowest. Now you come down to the base, the lowest point the market created. That is the base. You look at for the lowest point the market created. That is where you're going to be starting your analysis from. And now you've gotten the lowest base, the lowest point. Now the lower point right here is this particular low right here. This was the last low the market created, and that is where we're going to be starting from. After that low has been spotted, now mark out the high that created that low. Sorry, you mark out the high that actually created that low. Yeah, the high that created that low, and this is the high that created this particular low right here. This was the last low the market created. According to what we have here, this was the high the market created. Now you're going to mark out what I always look out for is always marking out that high and the low. Now we're going to assume this whole structure wasn't here yet. Let's assume this whole structure wasn't here. This whole structure wasn't here. If you're to trade alongside from this point, now we're going to be focusing on this high and this low. Now what we're going to do, we're just going to mark out the high, which is this high, and this low for a bullish trend. That is this is one strategy I always use You understand, guys? You mark out the recent high and the recent low the market created and the last low the market created. Sorry, I mean this is gonna be the last low. Let's use this because this. Let's use this since you're using the recent structure. This is gonna be the last low the market created, right? And now you can see what your focus would be on as the last low and the last high the market created. Whatsoever thing that is happening in between the high and the low is what we call internal structure. Whatsoever thing that's going to be happening in between this high and this low, whatsoever movement that's happening, the market is actually moving this way, this way, this way. Whatsoever thing that is happening in between that high and that low is none of your business. The market is simply what? Creating internal structures. All you should be after what is the major structure, whatsoever structure the market is creating, until the market breaks above the line, which is this particular high. Until the market breaks above it, that is when we now have what? A new high right here. Are you with me, guys? That is when we now have what? A new high right there. Now back to what we explained. Now if you can see, this was the last time the market created, and the market gave us a low right here. Now like I said, every low must always break a high. Every valid low must always break a high. This high low hasn't broken above this high because you're still using this. Now we have this low push to the upside. Now add what? Now gives us what? Give us a break of structure. That is where we add our what? Break of structure. We now take this out and then we mark this as our break of structure. This is where we now have what? Our valid break of structure. And now if you use this same scenario, you should never buy the market when it is expensive. If the market is currently around this area, do not buy the market. Let sellers come in. Always have this at the back of your mind. If you are to buy the market when it is what? When it is cheap. That is why I always use what I call Fibonacci retracement, my Fibonacci tool. You understand, guys? That is when I use my Fibonacci tool. Don't worry, guys. When we get to that part, I'm going to tell us how I use my Fibonacci tool. And now look at what we have here. Now wait for the market to pull back into a POI. And now if you can see what we have right here, for most traders would have what we call first POI right here and another POI right here. And the market came back, tapped into this POI right here. For example, now a point of interest right here. And that was where the market tapped into, went up, came back down, and then went back up, but did not break above this last high that was created. Now, did not break above this last high that was created. Now, there's what we call liquidity. Do you understand? There's what we call liquidity. We're still going to get to that, but let me explain something. Now, there's another POI the market created right here, and that was where the market came back to test. And now most traders are going to see this as what? As a change of character. But this is not a change of character, because this was the last low the market created. This particular low right here was the last low the market created before creating this bullish movement. And most people now, most retail traders will see this. Some traders will see this. Some newbies will see this as a shift in what? As a shift in market structure. And that is not a shift in market structure. Because this particular high, the last high right here, which is why I said you should always mark out the last high the market gave to us. If it's for a bullish trend, the last high right here wasn't really broken up, did not break above it. The price did not break above it, but then tapped into it and then came back. So this is not a valid break of what? Change of character. This is still our what? This is still our what? Valid low right here. This is our what? Valid low right here. So whatever thing that is happening currently right here, it is just what? An internal structure, because this is still the high, our last high, and then our last low. So whatever thing that is happening in between here is what we call internal structure. The market is still bullish. Only if the market breaks below this last low that was created, that is when we now have what? A shift in market structure. Now we now have our new low right here, and this is our new high. This is all market structure. You understand, guys? This is all market structure. I just want to let you know how all this works, because without market structure, whatever strategy you are using, you still take losses if you don't understand what is happening on your screen, what is happening in the market. If you don't understand what is happening in the market, and the market, you guys are gonna keep losing. That is why you should always study. You always look at the market like you should always study the market more like a movie. Imagine you watching a particular movie repeatedly. Watching a particular movie repeatedly, you would always understand what's going to happen in the next scene, because you've repeated the movie 4 to 5 to 6 times, and then you already know what's going to happen next. So that's how you should always take the market. If you understand. And now there's something I want to say. all pairs does not move the same way. Each pairs actually have its own movement. That is why I said you should always study the market to know which particular to know how this particular market actually moves. You understand? You just have to understand it. If this part, there are some markets that have some pair that actually does what liquidity grabbing, and the other one does what simple market structure. Some other market plays out with what trend line strategy and whatsoever. You understand? Now back to what we are saying. Now we have our last high here and our last low right here. This is our last low right here. Now the market came back and tapped into a point of interest right here, and that's where the market pulled up. And now we now have what a break of structure. Now I'm not explaining how this whole structure is. Now I believe this whole structure is getting clean. Now we now have what a break of structure right here. This is our valid break of structure. Let me adjust this. Let's assume this is below. Yeah, we have this below. This is now our valid break of structure. So anytime you come to the market, just don't get confused about the market. That is why you should always start your analysis from the base, so you can get where the market is going to. Now look at this. Now this is no longer our last low. Now we now have a base that actually gives us this break of structure. This is now our recent low and our recent high. Now we just adjust this. Sorry guys, we just take this to this particular low, because it's our last low, and this is our last high. So now you guys can see they are in between this high and this low, this low right here. You can see market has been creating so many structure, but then for the fact that the market hasn't broken below this low, the market hasn't broken below this low, we are still bullish. Only if the market comes back right from here, breaks below this low, now we now have a change of character. If the market comes back right from here, breaks below this low, we now have a change of character. But for the fact the market is still in between this high and this low, we are still bullish. And what you should always look out for is buying opportunity only. That is what you should always look out for buying opportunity only, so you can actually take the market to the upside. I believe this is actually clear. You can see the old drawing actually just drew out right now. It's very clear. You start your analysis from the base to the upside, and then with that being said, I want to believe, like I said, we understand market structure very well. And now, for whatsoever analysis you're going to be doing, whatsoever trader you're going to be, because we have three types of trader. We have the swing traders, the day trader, and the scalpers. And whatsoever trader you're going to be, all your analysis must be you must start your analysis from the higher time frame. From the higher time frame. Now we've gotten the whole our market structure and the price action all is. Now let's now go down to the first strategy, which is what I'm going to be teaching. The one I actually mostly use, which is SMC. Now, and this is where I'm going to be teaching us what liquidity is. And now, before then, what is liquidity? Liquidity simply means money. Liquidity is simply money. Where our stop losses are, that is what we call liquidity. For example, now we have market creating highs, came back, created a low. Now market came back, created high. You see this particular low right here. That is what liquidity is right here, because people actually took buys right from here. They took buy trades right from here. They took buy trades to buy the market to the upside. This particular low, there are a lot of money lying down below here. And now for big money, for the big banks, they always look out to take out people's money, and after taking out people's money, they will now push the market to the right direction. I'm sure most of you would have noticed this happening in the market. Big players will actually take out everybody's money that is lying below this low. After taking it, they will now push the market to the proper direction. That is how liquidity is. Whatsoever places you see highs and lows, liquidity are spotted. They're not just low only, also highs. Liquidity is also spotted highs. And now I love seeing liquidity being created for SMC strategy. I love seeing liquidity being created. And now we have two types of liquidity structure. We have the trend line liquidity, and then we have the double top and the double bottom liquidity, which is we have a trend line liquidity just like this, I'm going to explain this. We have a trend line liquidity just like this. This whole movement is what we call a trend line liquidity. Trend line liquidity, I use this as my liquidity, which is what this dollar sign as my liquidity. This is a trend line liquidity. And then we have a double top liquidity, and a double top bottom what? A double bottom what? Liquidity. We have a double top liquidity just like this. So let's do something like this. Sorry guys, let's do something like this. We have a double top liquidity just like this, and we have a double bottom liquidity. See market creating something like this. And this is the double bottom liquidity. Now let's start with the trend line liquidity. Now for example, now we have, let me take this off. We're a bullish trend. We see the market creating highs, lows, highs. Now the market has given us a new high. Now for every structure you're doing, for any time frame you're using, whatsoever time frame you're using, you start your analysis from the highest time frame. Now you always look out for what? The direction of the market, and then after looking out for the direction of the market, you come down to what? A lower time frame to check the structure. And our structure is what we're going to be marking now. Once you've gotten the direction of the market, that is a bullish trend. Now you look out for what? The recent high that has been taken out. That was taken out. Now you can see this is a structure right here. Now where was the last high that was taken out? This was the last high that was taken out. Now we had the break of structure right here. We have a break of structure, and now based on what I explained a few minutes ago, you should not always buy the market when it is what? Expensive. Buy the market when it is what? Low. And now low in what sense? Now for a bullish for SMC strategy, we always want to see big candlesticks forming. We want to see big candlesticks forming, and those big candlesticks what? Must break structures to the upside. We always want to see what? Big green candlestick for a bullish trend. We want to see big green candlestick moving what? Being what? Created to the upside. Now let's assume something like this. This whole movement now is what we are having right here. You see this bullish movement. This is what it's going to look like. This bullish candlestick. This is what it's going to look like right here on the structure. Now the last candlestick. This is what you're going to mark out as your demand zone for a bullish trend. For your demand zone, the last candlestick, be it red candlestick, be it a doji candlestick, be it a green candlestick, but the last small candlestick before this big candlestick is what you're going to mark out as your demand zone or your supply zone. Are you with me, guys? That is what you're going to mark out. That is what candlestick you're going to mark out, and it should always be what? It should always be at what? At the lowest point right here, at the lowest point of a very big candlestick, a very big what? Movement to the upside. Are you with me? For a very big movement to the upside, that last candlestick is what you're going to mark out as your demand zone, and then you're expecting what? To see the market come back into that zone. I believe that's all clear. That last candlestick that gave us before the big push to the upside, that is what you're going to mark out as what? Your demand zone. Now we have the demand zone right here. You can also use this as an added confluence. You use that you bring out your Fibonacci 2. You mark from the lowest point to the highest point the market created, and now this is what we call the premium price, and then what? The discount price. And now for those who want to set this same Fibonacci up, so you can see here I have the 0 level, the 1 level marked, and I also have the 0.5. So these are the three level actually selected. You can also copy this and set up your Fibonacci 2, and then with whatever color you want to use for your discount and then premium area. Now you can see I have the green and the gray, and this green part is on my premium area for selling or selling zone. But then for a buying zone, we're going to be looking at this discount area. Discount area is a point where you're looking for to buy the market from, which is this particular low right here. Now I can see mark here. So now this discount area, any demand zone that is currently in this discount area, it is the demand zone that are going to mark. The demand zone might also be above right here, but for the fact it is inside your discount area, then actually what makes it very valid. For the fact it is inside your discount area, it actually makes it very valid. But then sometimes there can be two demand zones, and when there are two demand zones like this, you wait for the market to get into the first one, and then If it doesn't give you confirmation on the first one, you wait for it to come back to the second one. Then from here, it gives you confirmation on the second one right here. You can now take your entries. Now we've gotten our demand zone. Let's assume our demand zone is right there. We've used our Fibonacci to confirm our demand zone. Now you wait for what the market to create. This is what the market is going to do. So, for liquidity, now I'm about to explain trend line liquidity. Now the market will come back, create something like this. Then it will do something like this. Now this is what we call trend line liquidity. Now most retail traders will see this as what? A break of structure. Right? They will see this as a break of what? A break of structure. Now I want to explain. This is SMC strategy. Listen carefully, guys. This is what? SMC strategy. I use this in killing the market when I see market. But then you have to be very patient with the market. You have to be very, very patient with your what? With your analysis. Now this is SMC strategy. Now this is what we call. Now you can see right here we have a demand zone that was never tested. Now my strategy tells me, SMC tells me to always buy the market when it gets into my demand zone after creating liquidity and taking liquidity. And most times, mind you, market doesn't create liquidity. Listen carefully, market doesn't create liquidity. There are sometimes it creates demand zone and then comes back into it and then continue pushing to the upside. There are sometimes market will just come back into it immediately and then continue buying to the upside. But then there are sometimes it will not get into it, but then keeps going to the upside. Now, this is what we call trend line liquidity. Can you see this? This is what we call a trend line liquidity. People's money are currently at this low because some people would have bought the market at all these lows. They have bought the market to continue the bullish trend, and now they now have, according to them, they now have what? A break of structure, and now people money are still what? Lying on this at this low right here because it's a bullish trend. They feel the market is going to what? Continue pushing the upside, and now their money is currently right here. This is why I put dollar sign right here, which is what? Where people's money are. Now market is gonna do this, and me, I would want to see the market take out everybody's money right from here. I want to see the market clear everybody's money, and then after clearing everybody's money, I want to see the market tap into a demand zone that was never tested. Are you with me? I want to see the market tap into the demand zone that was never tested. Now look at this structure now. Most retail traders now see this as what? A shift in market structure. Don't get confused, guys. This is not a change of character. This is never a change of character. This is what we call liquidity grabbing. Market only cleared out the liquidity that was this low and then now came back to the initial demand zone that was never tested. Now came back to this initial demand zone that was never tested, and then when the market gets here, what are you going to be looking out for? Now this is where entry types comes in. What are you going to be looking out for? Your entry confirmation. That is what we're going to treat last. This is when your entry confirmation, we have I use different types of entry confirmation. This is when your entry confirmations now comes in for you to take the trade and then continue to the upside. This is when your entry confirmation comes in. But then always let the market create liquidity area, and like I said, market doesn't really create, most of the times it doesn't create liquidity, and sometimes it does create liquidity areas. Market doesn't come back to test your zones, and there are sometimes it might create liquidity area like this and then would never come back to test it. We just keep going up, but later in the future the market comes back to that zone. It will definitely react from that zone, from this zone. If market doesn't come back, maybe keeps buying like this to the upside and never came back down, later in the future market comes back to this zone, it will definitely react from that zone. Even if it's to push the market up a little before coming back down, it will definitely react from this zone, because people stop losses liquid money are still lying below this low, that was below this low, and then you have to wait for the market to come back into this point before pushing to the upside. Do you understand? That is for trend line liquidity. Now let's go to double top liquidity. Now this time around we're going to be using a bearish trend. Now let's assume we are having market creating bearish structure. Now you can see market doing something like this after creating a break of structure. Now like I said, you only look out for the recent break of structure. Now we have the market giving us a new break of structure to the downside. Now we have a new break of structure. After a break of structure, we have our POI. We use our Fibonacci to check, just like I said, use our Fibonacci to check. Sorry guys, we use our Fibonacci to mark out the low to the high, and now our premium area, we look out for what? The demand zone, always at the lowest low. The last candlestick that gave us a bullish, a strong candle to the downside, that is what we're going to mark, the last candlestick. And then this is where we have our what? Our sell zone right here. We have our sell zone. Now, you're going to see market create something like this. This is for a double top trend line. You're going to see market create something like this. Something like this. See the market create something like this. Now look at this. I'm sure most of us have seen something like this. That is where most people now do something like this. You now see some people draw this as a support what? A support or resistance level to what? To sell from. Because they see market what? They always like you are being taught, you always want to sell when the market is what? Is in a resistance level or in a support level. Now they now see this as a what? Resistance level. Now market now gave us a break of structure right here. Are you seeing this? This is a break of structure. Mind you, this is only what? This equal height right here are what? Liquidity area. People's stop losses are right here. People that took sell to the downside, their stop losses are what? Above this point right here. Their stop losses are what? Above this point right here. People's stop losses are above this point right here. You understand? Now we're going to wait for the market to what? Come back. Most people will be looking to what? Sell the market when it comes back to this place and then continue the what? Sell to the downside. But then market is not going to do that. Market is not going to do that. They see this as a resistance level. They want to see the market come back into this point, and then this is where you see that most traders would wait for the market. Market would do this, would come back here, and then will start acting like it's beginning to what? Sell, and then before you know it, you will see the market what? Boom, push to the upside. Not knowing the market only created what? Fake highs. This is what I call fake highs. It created a fake resistance level for retail traders to what? To sell the market from. Now this is what I call double top liquidity. Can you see this, guys? This is what I call double top, equal highs liquidity and equal lows. You understand? Equal lows, same thing happens for a bullish trend, and equal highs happens for a bearish trend. Now if you can see, market created a fake high, and then this fake high gave us a break of structure. Look at this break of structure. Now the market gave us a break of structure. Now most people will see this as what? A shift in market structure, but no, this is not a shift in market structure. This is what the market only grabbed liquidity around here, and now this is where retail traders actually get it wrong. They see this as a shift in structure, and now they'll be looking to what? Buy the market maybe around this point, this low right here, or buy the market around a low right here. And then when the market gets to a point right here, let me explain how retail traders work. They mark out a low right here, demand zone right here to what? Buy the market from, because they see this as what? A change of character, and then market will do this. Then the market is going to react, act like it's going to what? Push to the upside, act like it's going to push to the upside, and then you see the market boom, do this to them. And when market does this to them again, they were like, oh, market has changed structure. Now market took them out again. Now they've had double losses. Are you with me now? Let me explain something to you. Now they've had double losses. Now how did they have these double losses? They had the first loss when they took sales from the market, boom, smashed them. The market came back down here. They took they took a buy right here, boom, and the market took them out. And then, don't knowing that the market only cleared liquidity around this area and tapped into the initial sell zone that was supposed to be tested, and then the market continued selling to the downside. And now you can see we now have what? The proper break of structure. Now, after seeing this, what do we have again? We have our break of structure. Now we have to use our Fibonacci again from this point, so from this low to this high right here. Now look at our premium area. You can see we can have a supply zone around this point, but I always love seeing what? Liquidity being created before what? Taking my trades. Now I can see I have a demand zone that gave me a candlestick, a supply zone that gave me a strong selling candlestick. That's where I'm going to mark. And now you can see this particular high that was created is only what? A liquidity area. This particular point is only what? Called a liquidity area. Market only created liquidity right here. People's stop losses are going to what? Be there to take sales from. This high is a fake high. Have you seen how liquidity is actually working? Same thing happening right here. A fake high. Market creating a fake high. Now you see market creating a fake high. This is what I always want to see. But most times the market could possibly sell right from here. It could possibly sell from this supply zone right from here. But I love, based on my analysis, my plan, my trading plan tells me the market must always grab fake highs, I always grab liquidity before I take my trades. So this is me following my trading plan. Now I'm not going to be selling right from me. I want to see the market come here. Market could possibly do something like this, guys. Listen carefully. Market could possibly do this, come back and retest this point, and then continue selling from there. But if the market gets here and then I miss out, so be it. My analysis, my trading plan did not play out at this particular point, and I wait for another opportunity. Do not always pursue trade. Always wait for the market. Always wait for your analysis and your trading plan to play out before you take your trades. That is when you tend to like win more. When you see your analysis being printed on the screen, then trust me, you're going to win more. If it's a week you're going to be trading, you trade once in a week. Trade only when you see your analysis being spotted. But now, if market does something like this, doesn't get to this point, now you're going to see them. For example, most people would take sales from here, like I said, take sales from here, and our market would again take them out. The market will do something like this. Now come back and tap into the initial supply zone that was never tested, not knowing the market only created fake low right here, a fake high right here for us to for it to come back and test this initial supply, the sell zone that was never tested. Now you can see all this being playing out. Now from here, this is where you now look out for entry points, entry confirmation, and then you take your trade right from here, and your target is going to be the last low the market created right, this particular low. That's going to be your target. Now you see, this is for the SMC. This is the SMC strategy. Now let's look at this on let's look at this on the screen. Let's use which pair are we going to use? Should we use Bitcoin? So let me clear this off. Okay, let me look out for a zone, an area where this supply SMC strategy actually happened. Okay, SMC strategy actually happened right here. Now look at this, guys. This is on the 4 hours time frame. Now I want to explain something to us. Look at now, we're starting from the base right here. You can see market creating highs, lows, and now market give us a break of structure right here. Give us a break of structure here. Good. They pulled back down into this fair value gap. This is where the market bought from. It bought from this fair value gap. From this, after filling this gap, but never came back into this demand zone right here. The market never came back into this demand zone. As you see, most times of the time, I tell you, market might not come back there, but would keep pushing upside. You can see the market. This red candlestick was the last candlestick that actually gave us this big movement to the upside, and that was where the market bought from. That was where the market market tapped into from here. Push to the upside, but market didn't come back to this initial candlestick right here. It never came back into this candlestick right here. It never came back there. But then, like I said, most of the time the market might not play out that way. Now, market gave us a break of structure. I want you guys to follow what I'm doing, and then we have another high created. Now, market gave us another break of structure right here. This is another break of structure right here. After this break of structure, where was that last candlestick that gave us a bullish movement to the upside? This red candlestick. After this red candlestick, we have this big movement to the upside. So we mark this red candlestick. And if you can see, market never came back into this our buy zone. Market never came back into our demand zone. Now, what are we going to do? Now, this is where market never came back. You can see market gave us a high right here. Then came back down, gave us a high, another high, gave us a break of structure. Right here. Give us a break of structure right here. I want you guys to listen carefully. Give us a break of structure, and then came back down. Give us another break of structure right here. And now you can see, most of at this particular time, I would not look to trade because market did not tap into my demand zone. market, and there was no fair value gap around there where market could possibly respect, because I can't be buying the market when it is expensive. I want to buy when it is low, because this was the fair value gap the market reacted from, and that's when the market started buying from. But no, I can't be buying at this fair value gap that is at a high price. As when the market pull back down and tap into a fair value gap, I could buy from there. But now look at what we have here. This is what we now call a trend line liquidity. Look at this. This is what we now call a trend line liquidity. Because market created what? Fake lows right here. Most people have taken buys right from here, because they see this as also what? As a support level. Because market has tested this point several times. Market tested this point 1, 2, 3 times, and then they see this as a support level. So when the market is coming back down, look at what I say here. Market would definitely always respect that. Market did what? Market definitely tapped into the support level, and then after buying, boom, it took them out. Now this is where they would have taken, most traders would have taken loss right here. They would have taken losses right here. And now I saw the market pushing back down. I'm like, okay, this is looking nice. This is looking nice. And I see market tapped into my demand zone. When I saw market tapped into my demand zone, I would have what? Look for my what? Entry confirmation. And then I would have taken my entries right from here. I was taking my entries right from here, and then boom, you can see market actually moved for a while. After tapping into this eye right here, it started what? Selling. But then the market did not close below this my demand zone. Mind you, I would have taken first entry right from here. Let me show you something. That is why it is very advisable to always what? Set break even. I would have placed first entry right from here, and my target is going to be this high. But then along the way, when I would have along the way, and the market is moving, I would have what? Set break even. That's what we call break even along the way. As the market is moving, I would have adjust my stop loss above my entry point, just in case the market comes back, because market can just call back and then take me out, and then but just in case the market comes back to take me out, and make sure I did secure what? My profit. But then we look at what the market, what happened right here. The market came back to tap into my demand zone. Let me delete this off. The market came back and tap into my demand zone. Look at this. But look carefully. This candlestick never closed below this demand zone. This candlestick never closed below this demand zone. When I saw this, if I'm to see this again, when the market came back down here into this zone, and I saw this, I would just go down to a lower time frame. Then on the lower time frame, I'll be looking for what? Entry confirmations again, because this market went back up, but did not get to this high, because this was the highest high the market created. The market did not come to this high. Then I would have waited for the market. Market came back down here, but then the candlestick did not close below it. The candlestick did not close, but then only came back then and then rejected inside and closed inside the demand zone. If I'm to see this, I'm like, okay, this will definitely look to me like, okay, but buyers are still in this market. Market only grab people's stop losses. Now look at this. Market only grab people's stop losses, because normal I said I was going to take buy right from here, right from this point, buy right from here. Market would have taken out people who didn't set break even. Market would have taken them, and that is why it is advisable for you to always set break even when you are in a trade. If your trade is actually moving in profit, you set break even to secure your profit. Now market grab our break even, took us out, liquidated us, and then still came close inside this. And then I would have taken another entry right from here, and then I would have put my entry right from here, my long position right from here, spotted an opportunity. Now my stop loss is just going to be below this low, or depending on the time frame I use in doing my entries, and then my target is going to be all the way to this high. And then there's another secret I want to tell you guys. Always make sure if this is the highest high right here, this is the highest point, and your TP3, always make sure your TP3 it is not exact. It should not be exact to this high. You should always take it lower a little bit, because most times the market might not tap into get to the highest high, but then start coming back down all the way down, and then before going back up, or from it can actually reverse from there all the way up and change direction, because we don't know what the market could do. Market can possibly come back up right here and then change direction of the market. Now look at guys, look at this. This is actually a very nice trade, because for those who are actually using 4 hours time frame for their confirmation, they would have used this as a confirmation, because this is actually those who trade with pattern. This is a double bottom pattern. Look at this. Market created the first bottom right here, pushed back up, came back then, and now gave us a double bottom confirmation. But those who actually, for me, who I'm actually a day trader, I would have taken my entry right from here, boom, and then secure some profit. Then when market came back here, I would have taken another entry right from here. Now look at all this playing out. But market never came back to this previous demand zone. Right here. Market never came back to it. But then boom, continue pushing to the outside. So we take this. This was never tested. This is the recent value demand zone. I look at this. This is actually what a very nice trade. This would have been a very nice trade. You waiting, do you know how many days you would have waited for the market to come back, grabbing, taking out this liquidity right here, and then tap into this? You would have made first profit right here. Then when market came back here, you saw this candlestick closing inside your demand zone. You would have taken another entry right from here, and then leave the market all the way to this, and then you'd have made what? Made massive profit right from here. You'd have made what? Massive profit right from this. Is for what? For SMC strategy. Now let's now move to what we call a price action strategy. This is another strategy I always use. Now price action simply means what is happening currently on the market, which is what I call the support and resistance, breakout and retest strategy. Now we have the market creating zones like this, creating highs, lows, creating something like this. Now you can see what we have here. We look at what the market is creating. Now, if we have this kind of drawing, what should you do? First, look out for what? The recent trend of the market. Let's assume the market is what? It was currently bearish. Market was currently what? Bearish. Let's assume the market was currently bearish, and then we have market will change direction. Now we now have this. This is our what? Shift in market structure. And now for support and resistance, you always mark out what I call key zone. Now you change this to a line chart. You can see this my arrow right here. I look at what for the recent place the market actually was tested for a couple of times. Like where is the place the market has tested for a couple of times? I can see an area right here, and I always like marking out my support and resistance zone as a what? As a zone. Now look at this. Look at this, guys. Look at this. Now market created a low. Market gave us a low right here. This low was what? Was tested right here. Market went back up, came back down, gave us another low, went back up, and the market broke below it. After breaking below it, it came back, it tested again, went back down, and after breaking above it, you can see the market coming back down to test it again. After testing again, it pulled back up, and then came back down here. After coming back down again, still went back up, still respected it, and then broke below. After break below, market came back up. Now after market coming back up, like I said, this is another support and resistance strategy. Now this is actually what? Turning support, because market just broke above a major zone. What are you going to be waiting for? You wait for the market to come back and test this major zone, but not just testing the major zone. Wait for the market to test this major zone for you to what? Continue the bullish trend to the upside. The market doesn't come back and test that major zone, then you leave it. Look out for what? Another trading opportunity. Market comes back and test this major zone, then you can now take your buys right from there and then continue what? The trend to the upside. That is how support and resistance. You just look out for what areas the market has what been testing couple of times. Now let's now look for an example and let's see how that is going to happen. Let's look at the chart. Let's look at for the chart. For example, now we have a bullish trend. Let's look out for a zone where the market has tested for a couple of times for a bullish trend. Let's see. We don't have any. For easy view, you can just change this to a line chart. A line chart will give you the best view. Look out for what areas where the market has tested for a couple of times. Okay, we can't find any currently. Let's see. Okay, we have one right here. We have this right here. Look at this, guys. We have this right here. You can see the market what? Here, went back, broke above, came back to test it, went up, came back down, went above, broke below it. I can see when market came back here, it sold to the downside, and then after selling to the downside, market went back up, came back down, and then coming back to test it, and then came back down, and then broke above it. Now, what are you going to be expecting for the market to do? Obviously, we want to see the market come back to test it. That is for support and resistance trader, which is why I use sometimes. I don't really use most of the times. I use SMC most of the times. Now you want to see the market do this. You want to see the market come back, because you cannot see, we don't have an area for us to what? Buy from. But the market pulls back down here. This is how I'll be looking to what? To buy the market what? From. Gives me confirmation right here. I'll be looking to buy the market right from here all the way to this highest point. Are you with me? To this highest point. Now let me show an example of a trade I took today with and the signal I give out to my VIP members on GBP, I guess GBP AUD. GBP AUD, yeah, GBP AUD. Let me show you guys how I did the analysis and how I got that trade. Okay, yeah, GBP AUD. Look at this, guys. Look at this. Let me start from analysis from the higher time frame. I started this analysis from the weekly time frame. I started on the weekly time frame, and then on the weekly time frame, what can I see? I can see what? A bullish movement right here. Can see a bullish what? A bullish structure right here. This is a bullish structure. Market creating highs, lows. It's a bullish structure. This was the last low the market created from this. After this movement, market gave me a new high, and this low has not been taken out because this is still this low right here. It still hasn't taken out this last low the market created because this is still a bullish trend. Now I saw that, and then what did I do? I saw this trend line right here. I marked this as my trend line. So the trend line I saw for this recent structure, because I saw market tapped here one, came back the second time, and then the third time, and then it is spot pushing to the upside, and then the rejecting off here. Now I've gotten the trend, bullish trend, and I went down to my structure time frame. I guess I saw this on the 4 hours time frame or so. Guess I saw this on the 4 hours time frame. Was it the 4 hours time frame? Yeah, I saw this on the 2 hours time frame. The market was hold on, guys. Yeah, we bought the market right from here. Now how did we buy this market? I saw this trend line zone being created. Look at, I saw another trend line zone right here. Look at this. I always draw my trend line or my support and resistance as a zone. The candlestick must be inside it. I must always be as what? Like a zone. Now I can see this. I had the first touch right here, the second touch right here. And now market tapped into this as the third touch. And now look at this, because this wasn't my first confirmation. I always love to see two confluences before taking any trade. I love seeing 2 to 3 confluences before taking any trade. I looked at this when the market tapped here. You can see market approaching this particular zone with big candlestick. Like, okay, this might not hold well because of this trend line. I saw this trend line that has been respected for a couple of times. I like, okay, that was the first confluence. And then what was the second confluence I was looking out for? Like, okay, was this place, was there a major zone? And then I saw a major zone at that point. I changed this to a line chart. And if you see here, you could see this as a major zone. You can see this. I drew this right from here. This was a major zone for me. Look at this, guys. If you take this to the back, it's a zone that the market has tested a couple of times. Look at this. This was a zone the market has tested. Look at this. Take this to the back. Can you guys see this right from here? You can see market tested here, went down, and the consolidating have moved this point, then broke below, tap this point, and then sold. And you can see when market came out to test it, it actually went to the upside, then came back down to test it, went to the upside, then break below it, and the market broke above it, tested again, went up, broke below it, tested, went down, and the market broke above it, came back to test it right, and then went above, and the market came back to test it. When I saw this, I was like, okay, my first confluence is what? My trend line, good. My second confluence what? Is this major zone, which is my support level, because it's actually what? A major level in the market actually what? Giving to me. That's why I said you should always what? Change this to a line chart so you can see this you can see this what? Zones carefully. You can see this clearly. If you use a candlestick like this, you won't be able to spot those. But look at this. Look at how market actually what? Be reacting off this major zone. When I saw this, I immediately took buys right from here aggressively. That was where I actually what? Took my buys from. Immediately the market tapped because I knew this actually what? A very strong zone, because I saw what? 2 confluences, a trend line zone, and also what? A major support zone. And then I took my buys right from here. My target is going to be all the way to this what? To this. And you can see it's actually what? A wonderful trade. So those are the 2 strategies I actually use. A trend line which is support and resistance, and now which is support and resistance, and also SMC, which is what you always wait for the market to take out liquidity. And also this, I actually never wanted this particular class to be long, but then let me now teach us entry types. Now I have various types of entry types. Now I'm going to be teaching us the first one, which is what? Market structure entry type. Now, for example, like I said, for a demand SMC strategy, we have the market creating highs, what lows, then creating another high, now gave us a liquidity area. Let's assume it's a liquidity area, and then market now came back into our what demand zone. Now we have our what sorry guys, we have our demand zone right here. We have our demand zone spotted right there. This is our demand zone right here. Now you see this whole move. This is going to be on the higher time frame. We have our what liquidity here. Liquidity right here. Market tap into our demand zone. Now we cannot just enter this market blindly. Now look at this high. From this high right here to this low. This is on the higher time frame. This is an higher time frame what structure picture. Now the market is going to look like this on the lower time frame. It's going to start creating movements like this, either the 15 minutes time frame, the 5 minutes time frame, or whatsoever time frame, and the market is going to be like this on the lower time frame. Let me explain this. Now this is why I say structure strategy. Now you're going to mark the last time the market created. This is the last time the market created that broke structure to the downside on the 15 minutes time frame. Now after this last high was created, now market has gotten into your demand zone. You always want to wait for this high to be taken out on the lower time frame, so it has to align with what your lower time frame has to align with what your higher time frame structure is telling you. Now if this you mark this last high, now you want to see this market break above this last high. If market does something like this, then you now know that okay, now this has been confirmed that okay, yes, buyers will start coming into the market, because your lower time frame has now shifted structure. Now you now wait for the market to come back. Now just like I explained, now there's going to be a demand zone, a small candlestick right here that gave us that bullish candlestick to the upside. Now that candlestick is what you're going to mark whatsoever time frame you see, is either the 5 minutes, 15 minutes, or the 30 minutes. You wait for the market to come back into that candle, that zone, and the market comes back to that zone. You wait for an engulfing candlestick, because that is what most people actually get it wrong. You wait for a very big green candlestick that an engulfing candlestick, and after the close of that big engulfing candlestick, you take your trade right from there, and then your stop loss is going to be below this major zone on the 4 hours time frame, and then right from there you continue you take your trade. That is the first entry types. Let me make this clear. Let me make this a proper explanation. Let me do the drawing properly. Now we have market coming down. Same with normal structure. You see market tap into our demand zone. You wait for the market to break above this last time that gave us a break of structure down. When market breaks above it, market could possibly come back to retest this point here, because it's actually a major zone. If it doesn't come back to retest the point, breaks below, there's definitely going to be either a fair value gap right here or a demand zone. And then when market gives you a demand zone, you want to see rejection candlestick, and after the rejection candlestick, you're going to see a big green candlestick closing above a previous red candlestick. And when you see that, you take your buys after the close of that green candlestick. You take your buys all the way to the upside. That is how it's been traded. That is how it is being traded. That's if the market doesn't come back. And now you can see this place actually more like a major zone. The market could possibly come back, test here, and then so should be always watch out for where the market always to react from. Market could possibly do something like this. There's not a must for it to come back down here. It could possibly react from a major zone or lower time frame, and then from there it can start buying to the upside. That is my first entry types. That's the first entry types I use. As well as another entry type I always use, which I call a double bottom. Now a double bottom in the sense that this a double bottom or a double top. For a buy trend, I'm going to be using a double bottom. Now market taps into this. I'll see market shift structure. Then I'll see this is going to be on the higher time frame. Market can buy on the higher time frame. Then comes back down to test that same zone. After market gives me, now I want to see the market give me. This is actually not looking like a W. Then I wait for another that same big green candlestick. When that green candlestick is being has been given, then I will not take my trade at the close of that green candlestick. It can be on the 1 hour time frame, the 2 hours time frame, the 30 minutes time frame, and then right from there you can take your trade all the way to this point. That is also this is also another entry types I also use for SMC. I use these two And most times I go in aggressively. When the market taps into this point, I enter the market aggressively without waiting for a confirmation. But it's not advisable for you to wait for to enter the market aggressively. Always wait for what? On lower time frame, wait for a shift in market structure before you take your trades. You understand? Always wait for a shift in market structure before you take your trades. And now for support confirmation entry types, for support entry types, for example, now let's assume we have the market do this. We have the market do something like this. And the market breaks above it, then comes back to test it. Let's assume this is a major zone. Now, how do we approach this? If you're on the lower time frame, let's assume the market is, this is where the market is. Now, market broke above a structure. Always wait for this structure to be tested 2 times before you take your entries. That is another entry confirmation. The market tested the first time. Wait for the market to break above this high that was created right here. Market breaks above it. Wait for the market to come back and test it. This is what I call double bottom. This same entry type can also work as well on the SMC as well. The market comes back to your demand zone. It can work also as well. Now market creates a double bottom right here. Wait for a bullish green candlestick. At the close of the green candlestick, you take your what? Take your entries all the way to the upside. That is how it is. This is what? A double bottom confirmation. Make sure the market tests that zone 2 times. Listen carefully. I make sure the market tests the zone twice. If the market comes back, that you want to come back down here, tap into the zone, went up, break below it. The market comes back to test it. Wait for the market to break below this last low that was created. Market breaks below it. Wait for it to come back and test this point. At the close of the last red candlestick, you enter your sell all the way all the way to the downside. That is how. Those are the 2 entry types I always use. Only if you want to enter the market aggressively. And I believe with all this, you can actually start killing the market. With all this, you can start killing the market. And now if you are entering the market, like I said at the beginning, if you are following your trading plan like this, there are sometimes the market might not come back and test it the second time. The market might just do this and then continue selling. But if the market doesn't do that, do not take any trades. Always wait for your plan, your strategy to play out before you take your trades. You understand? And I believe if you have any question after watching this video, you can actually drop on a DM, drop it in my DM, and that's gonna be the end of the section. See you guys.